Welcome to the deep dive. So if I asked you to define income, you'd probably say, well, it's the increase in your wealth over a period of time.
Right.
It sounds so simple. You start the year with $200,000, you end with 220,000, and, your income is 20 grand.
And that simple sort of intuitive definition, that increase in wealth, is actually where all the complexity begins.
Ah, okay.
Because depending on how you define wealth and, how you even measure that increase, that single $20,000 gain can become 14,000 or even zero.
And that is exactly our mission for this deep dive. We're taking one, seemingly straightforward transaction and using it to look at three fundamentally different ways of measuring accounting wealth.
Yeah, and this isn't just some academic exercise. Understanding these different frameworks is really the key to critically reading any financial report you come across.
So what's the scenario we're working with today?
The scenario is, I think, a perfect illustration. So imagine you start the year with a house. You bought it a while ago for $200,000. That's your beginning wealth.
Okay, got it.
During the year, you sell that house for $220,000 in cash. That's your ending wealth.
So you're indisputably $20,000 richer in just raw dollars.
In nominal dollars, yes.
Right.
But from that single fact, we get three possible income figures.
20,000, 14,000, and zero. Okay, let's unpack this. We have to start with the most intuitive one, the full $20,000 answer.
Yeah.
So that $20,000, that represents the baseline, right? It's what drives almost every financial statement you've probably ever seen.
It is.
What's the core principle that, justifies counting that entire monetary increase as income?
That principle is called the financial capital maintenance concept, or FCM for short.
Okay.
And its premise is really simple. It just says that income is the increase in your nominal financial wealth over a period. We only care about the dollar value difference between start and finish.
So we're just focused on the numbers in the bank account, the numbers on the ledger. We're not worrying about what those numbers actually mean for, say, buying power.
Precisely. The focus is purely on the nominal dollar increase. So the formula is super straightforward. Income equals your ending net assets minus your beginning net assets.
And in our example, that's $220,000 in cash minus the $200,000 historical cost of the house.
Which gives you $20,000 of income. Simple.
So if it's that basic, why is it the foundation for, huge accounting standards like GAAP and IFRS all over the world? Why does the whole financial world lean on a measurement that seems to ignore real-world context like inflation?
That's the key trade-off. And it gets at the main purpose of external financial reporting. FCM is valued not because it's the most economically realistic view,
Right.
but because it is the most reliable and verifiable one.
Verifiable, because I can show you the purchase document for 200 grand and the sales contract for 220.
Exactly. That objectivity is what makes financial statements auditable. If we started introducing, subjective adjustments into every single calculation, investors couldn't compare companies. Auditors couldn't give any assurance.
I see.
And it also follows something called the realization principle. We only count the income when the asset is actually sold and the cash is in hand. The very clear, objective cutoff point.
So the $20,000 gain is what regulators like because it's objective, it's clear, it helps predict cash flows, even if that gain might be, eaten away by other economic factors. But this leads us right into the main criticism, doesn't it? If the value of the dollar itself is falling, how much of that $20,000 is just, smoke and mirrors?
That is the major flaw. And it becomes really obvious in periods of high inflation. That $20,000 figure can be very misleading because it counts these monetary gains that don't actually translate into a real increase in your purchasing power.
You're not actually able to consume or reinvest any more than you could before.
You might not be, no.
And that critique, this idea of maintaining your real purchasing power, is what gets us to the second measure. And okay, here's where it gets really interesting.
Yeah.
We're moving from just counting dollars to measuring real economic gains. So why does adjusting for inflation suddenly knock $6,000 off our income? How do we get down to $14,000?
We're now using what's called the financial capital maintenance concept adjusted for inflation.
Okay.
And the big insight here is that to measure a real increase in wealth, we have to first make sure that our initial capital, the $200,000, keeps its original purchasing power.
Right. So if prices go up 3%, you need $6,000 more just to be able to buy the same stuff you could have at the start of the year.
Exactly. You need that just to stand still.
So you're basically just raising the starting line to account for the fact that the dollar is cheaper. We're measuring an increase in constant purchasing power, not just a bigger pile of cash.
That is the perfect way to put it. The focus is on the real dollar increase.
Okay, so let's walk through the math. Let's assume a 3% general inflation rate for the period.
Right. So 3% inflation on that beginning capital of $200,000
Yeah.
means we need to set aside $6,000. That's the cost of staying even.
Right.
So your beginning capital, when you state it in year-end dollars, is now 200,000 times 1.03,
Oh.
which is 206,000.
So $206,000 is the new break-even point in real terms.
It is.
That makes the calculation really clear then. Real income is the 220 you ended with, minus that adjusted 206 starting point, and that leaves us with a real increase of $14,000.
Exactly. And that $14,000, that's the amount you could actually go out and spend without being worse off in terms of what you can buy in the economy. It's a much more, I would say, economically honest picture.
It definitely feels more honest. But if it's so much more realistic, why isn't it the standard? You mentioned it's generally not used in, say, U.S. financial statements. What's the barrier?
The barrier is mostly about implementation and objectivity, again.
Oh.
To do this, you have to pick a general price index, like the CPI. But which one? The CPI for all urban consumers. The one for wage earners. They give you different results.
So how often do you update it? It seems like it could get complicated fast.
It does. And regulators worry that if you require all these inflation adjustments, you introduce this layer of subjectivity and complexity that might, undermine the reliability and comparability that the $20,000 figure guarantees.
So it's always this trade-off. The $20,000 method is simple and auditable, but maybe misleading. The $14,000 method is more realistic, but it's harder to standardize.
That's the conceptual battle at the heart of accounting. You're always choosing which flaw you're willing to live with, the flaw of being too simple or the flaw of being too complex. And for public reporting, they almost always choose the simpler, more auditable flaw.
Okay, now we took the biggest leap. We go to the most, I guess, theoretical and radical answer, zero income. To anyone listening, this has to be the most counterintuitive result. You're standing there holding $20,000 more in cash, but somehow you've earned nothing. How do you possibly justify zero?
You get to zero by defining capital in a completely different way, not in terms of money, but in terms of physical function. This is the physical capital maintenance concept, or PCM.
Physical capital maintenance.
Yeah. And this viewpoint says that income is only earned when the physical capacity of the entity, its ability to produce goods or services, actually goes up.
So it's not about the money I have in the bank, it's about what my assets can do.
Exactly. The core idea is that you first have to maintain your productive capacity. Any cash you get that's just needed to replace or maintain that capacity isn't income. It's just a capital maintenance adjustment.
Okay, so let's bring this back to our house example. What's the physical capacity we're trying to maintain here?
In this very simple case, the house provides the physical resource of shelter.
Shelter, right.
You started the year with 1 unit of shelter. If you sell that house, you only have real income if you have enough cash left over after you've replaced the physical asset you sold.
Okay, so if the replacement cost of a similar house, the cost to maintain that exact same level of shelter, has gone up to exactly $220,000.
Then all $220,000 you got from the sale has to be used just to replace that house.
And that's how we get to zero.
That's the whole mechanism. You started with one house, you use all your revenue, plus that $20,000 nominal gain just to end up with one replacement house. Your physical resources haven't changed, your capacity for shelter is the same, so under this concept, your income is zero.
That $20,000 wasn't profit, it was required reinvestment just to stand still.
It was an involuntary capital adjustment, yes. Now think about a huge company like an airline. They bought a jet 10 years ago for, say, $100 million. They report profits based on that historical cost, the $20,000 income idea. But if that same jet now costs $130 million to replace, they have to realize internally that $30 million of their profit is just needed to maintain their fleet.
And if they pay out dividends based on that nominal profit, but they should have been thinking about the zero PCM profit.
They risk paying out the capital that they should have kept just to replace their assets. That is the huge danger of only looking at nominal income. It leads you to underestimate how much you need to reinvest, and you can slowly erode your physical capital base over time.
So managers in big capital-heavy industries have to think this way, even if it's not what they report to the public.
Oh, absolutely. They have to. They need to know if they're actually growing their capacity or if they're just financing rising replacement costs.
Wow. This really has been a journey from, simple nominal wealth all the way to productive capacity.
It's a big jump.
We took one transaction, a $20,000 cash gain, and got three totally defensible results. 20,000, which is the nominal gain, 14,000, the real purchasing power gain, and zero, no increase in physical capacity. So what does this all mean for someone listening when they're looking at the financial news or a corporate report?
The most important takeaway is to remember the default setting. If you see net income on a report or you're asked for income in any kind of standard context, the answer they're looking for is based on the financial capital maintenance concept.
The $20,000 nominal increase.
Yes, that's the bedrock of GAAP and IFRS because it's objective. That's the rule.
But the real understanding comes from knowing why that's the rule and what its limits are.
Exactly. The $14,000 figure forces you to ask about inflation, to ask if that reported profit is a real increase in wealth. And the $0 figure, the PCM idea, forces you to ask the ultimate economic question. Does this cash gain actually represent an increase in my ability to produce or consume, or is it just the rising cost of staying in the same place?
It really does turn any income statement into a kind of puzzle where you start to see that, simplicity and reliability sometimes come at the cost of economic realism.
That's it. You're learning the trade-offs. The reported number is reliable, it's comparable, sure. But it often needs a critical eye from an analyst or investor to really get at the company's true economic performance and its ability to grow in the future.
It's incredible that something as basic as defining profit can be so, philosophically deep. Thank you for walking us through these three different realities.
My pleasure. And I guess I'll leave you and everyone listening with his final thought.
Okay.
We've seen that the $20,000 figure is objective, it's easy to verify, so it's great for reporting.
Yeah.
But the $0 figure, well, it's arguably the most honest indicator of whether you've actually improved your economic condition.
A profound difference.
So think about that in your own life. When you measure your own financial success, how often do you just look at the nominal number, the size of your raise, or how much your investment portfolio went up? And how often does that simple number hide the fact that you needed every single one of those dollars just to keep up with the rising cost of your life, your housing, your food, whatever it is? I'd challenge you to look beyond that simple dollar gain. Ask yourself, am I actually better off in terms of what I can do, what I can provide, or did I just run really fast to stay in exactly the same place?